Hello, it's your financial friend Maggie. Welcome to the Inside Out Money Podcast. Hey, Andrew.
Hey, Maggie.
How are you?
Good.
We're here for another listener Q&A episode. And if you're not sure like where you are and what listeners we're Q&Aing, welcome to the Inside Out Money Podcast. This is a personal finance podcast focused on redefining wealth from the inside out. Every week, I speak with a rotating set of co-hosts about a different financial topic, something that will help you improve your financial mindset and tactics. Today, we have co-host Andrew here, and we are going to do, I think maybe this is like our third listener Q&A episode we've done, you and I.
Yeah, I think we done. Well, we did. I think we did one before, and then maybe the case study.
Yeah, that's true. Yeah, there's been a number of listener Q&A episodes. I like these. It's like a grab bag of a bunch of different mini topics. So, and I was going to start with just a fun story that, speaking of our case study episodes, when I was at Camp Phi, I met one of the people we did a case study for. I didn't make the connection at first, and it was Shanna. So shout out to Shanna. And she was like, you did my case study on your, and I was like, oh, I just did. I don't remember, like every single name of who we had done case studies for. But I definitely remembered doing hers, and it was just fun to like put a face to the name. And one of the many reasons I love Camp Phi.
Mm-hmm.
That's got to be a 2026 or 2027 goal, is to get Andrew to a Camp Phi.
Yeah, I'd love to go at some point.
You could ride your bike there.
It was in Florida, right?
Yeah.
Yeah.
Yeah,
Okay.
It's like 5 hours from Atlanta. Okay, so what's funny is the very first Q&A we're going to do is actually Andrew's own question that we were in like a text exchange the other night about this. And then we were like, oh, this would actually make a good episode topic. And it's probably not a dedicated one. And we've actually done an episode on what to do with a lump sum of money. Like if you get a big inheritance or you get a lump sum for big bonus at work or something. And I can put a link in the show notes to that. Liz and I talked through some kind of order of operations and like what to think about there. But you have a lump sum of your own now. And why don't you like talk through that and what you're trying to decide?
Yeah, so this is one of those situations where it's easy to give advice. It's sometimes hard to execute your own advice. Mm-hmm. So when I left Carter's last year, I had a deferred compensation plan that I'd been there 11 years. And for the first 5 years I was there, I aggressively put money into a deferred compensation plan. And with the market returns over the last 10 years, it grew to be a pretty sizable amount. And so unfortunately, the Carter's plan, if you left after the age of 55 with 10 years of service, they let you pay it out over a 10-year period in equal installments, which would be fantastic.
Right. Space out the tax.
Right? And so, but DCPs, it's not like a universal thing. Like, every company has their own rules. Maggie's talked about hers quite a bit, and they're all very, very different. And
yeah.
And so with the Carter's plan, if you didn't achieve age 55 and 10 years of service, after you left, 6 to 12 months after you left, they would pay it out in a lump sum. And
yeah,
so
you're like penalized by, they're like, oh, you don't, right. Which is kind of funny, but whatever. Yeah. That you're, here's you're not going to get to choose how you can't optimize this.
Correct. Yeah. And so if you leave in the first 6 months of the year, they pay it out at the end of January. If you leave in the second 6 months of the year, in the second half of the year, then they pay it out in July. And so I'm in this situation where I left in the beginning of last year. And so I received the lump sum payment last week. And I knew it was coming, and I had been debating for a long time about what I was going to do with it. And
where is it right now, Andrew?
It is currently sitting in a high yield savings account.
I just want to make sure I didn't spend more than 12 hours in your checking account.
Yes, it hit my checking account, and I immediately moved it into my savings account. Okay. And so it's sitting there, nice and comfortable in the high yield savings account. And that's certainly a nice, safe, warm place for for it to be. So I think if you look at as we've talked about before, if you look at the math of this problem, the math says that 70% of the time, a lump sum will outweigh dollar cost averaging it into the market.
Well, let me say that a different way. The historical math tells you should just dump it all into the market as soon as you have the money, not dollar cost average.
That's correct. Yes.
I just wanted to clarify that for people.
And the theory behind that is fairly straightforward, where time in the market outweighs timing the market. And so the faster you put it in, the better chance you have of time. Now, if you put it in and the market takes a dump and drops 20% the month after you put it in, yeah, you're going to be in that 30% bucket that it was not advantageous to put it all in.
Right.
But because the markets go up and to the right, you are better having the time in the market. And so,
well, can I ask you a question?
Yeah.
Why are you second guessing that data and that method? Because that's the crux of this answer, right? Is like,
yes,
this is
exactly.
what you're trying to figure out.
And the challenge I'm having is that this market is an all-time high.
Yeah, and many would say overvalued. And
correct.
There's a lot of,
if you look at the CAPE ratio, it's never been this high before. The valuations are disconnected from reality. Right, valuations are tied to earnings of companies, and company earnings are, especially within the Magnificent Seven, which represents 35 or 40% of the market right now. When you've got companies like Tesla that are trading at 430 times earnings, which is just insane. Right? So it's just the market is so frothy right now that it is hard to physically say, okay, this is all going into VTSX, even though I know that it is the right thing to do mathematically.
Long term, it's probably the right thing. But this
Correct.
feels, I agree. But can I give you, I know you know this. Well, first off, I don't want to forget, you mentioned the CAPE ratio. Yeah. For anyone who's like, what's the CAPE ratio? We actually did an episode number 67 titled 2 Investment Metrics You Should Know, CAPE ratio and SORR, SORR. And so you should go listen to that. We're not going to get into it now, but it's a good explanation of kind of what Andrew was talking about. But Andrew, I feel you on your hesitation. But I think I've told you this, but it's worth verbalizing. I have been sitting on not as large of a sum of cash as you just received, but still cash since I retired almost 4 years ago now, because at the time I also thought the market was due for some corrections 4 years ago. And it has increased heavily over the past 4 years, of which I have missed out on much of it because I've been, stuck on a similar thing that you're stuck on.
Mm-hmm. Yeah. And I think if I had left a year earlier and I was in this exact same position last year, I could make those exact same arguments in January of 2025, and I would have missed out on 15% returns at the market in the last year. And so, I think you could, you have the quote that you're always investing at all-time highs. Right.
Yeah.
If you were dollar cost averaging, you're going to be investing a lot of times. You're going to be putting money in the market when you're at all times highs. I think it's just the mental gymnastics of it being a lump sum, and that fear of what if the market drops 20%? Oh, I could have just waited out a couple more months and I'd be quote up 20%.
Well, and to your point on the mental gymnastics, the fact that my example of how I've been waiting like 3.5 to 4 years now actually isn't necessarily for the idea of putting it all in. It almost would say, oh, well, now that it's been 4 more years and we're still this, we're really due for a correction now, right?
That's where your sunk cost theory.
Yeah. Sunk cost fallacy. It's called fallacy for a reason, right? So, yeah. And so it is, but it's important to recognize this, because the psychology of this and your reference of mental gymnastics is what makes doing this more difficult. It's what makes everything with finances more difficult, is that we're human beings with feelings. we can tactically and or research wise read what we should do, but it doesn't mean it feels comfortable or that there's not a lot of reasons why we want to think that this time's different.
Yeah. And I 100% agree. I've always advocated that personal finance is personal and it's much more about the behavior. I think that I will get to the point of putting it all in pretty soon. I think, it came in on Friday. I thought about it more over the weekend, and I think I will get close to being able to go with the lump sum and just go go for it.
So when we were texting, you laid out 3 scenarios, right? It was lump sum it in, put it all in like today.
Right.
Dollar cost average it in over a period of time, which if you did that, what would you do it over? Like what period of time?
Probably a year.
Okay.
Right.
So you split it up over, a week,
right.
and you can put, 52 weeks, and you can literally divide the amount by 52 and do an auto. You can set that up to automatically happen, an automatic buy. I mean, and then your third option was leave it sitting in a high yield savings account while you wait for said correction, right? Like keep it in cash.
Correct. Or actually a combination of the two, right? Is to split it, put half in right now and then dollar cost the rest of the half.
Well, and that's why my answer to you was, you said option A, B, and C and laid them out. Yeah. And I was like, well, I would do option D, which is all of the above.
All of the above. Right.
I would split if I was doing it right now, which I kind of am doing it right now because I am still sitting on more cash than I arguably should have. Mm-hmm. I should is, a big word, but you know what I mean? And I would split the difference because you're sort of hedging your bets, right? And you're saying, it may not actually be thirds, but you might say, I'm going to split it in thirds. I'm going to keep a third in cash. I'm going to put a third in today. And then I'm going to take the last third and I'm going to dollar cost average it over the next year. Mm-hmm. And you're kind of you're covering all the bases just in case.
Yeah. Maybe now you're convincing me to rethink it.
Well, I don't know. I'm not saying you shouldn't, you already have enough in cash. If you didn't have enough, and this, we go through this thinking in that episode I referenced about that Liz and I did on how to handle a windfall, right? The first thing is you want to make sure you have a very healthy emergency fund. You already have that. Mm-hmm. But if someone didn't, they would definitely want to keep a big chunk aside for cash and taxes. Obviously, there's a big chunk you're holding for taxes too. Okay, so you think you're going to put it all in though?
I think I'm leaning in that direction.
Yeah. I think I'd go halvesies.
Part of my thinking is that if I was still there, if it was still in the account, there was no way in the world I would ever sell it.
Yeah.
Right. So so play through the scenario of
so you put it right back where it was.
If I was going to be exactly, I'm putting and
because it did get sold when they gave it to you. It was sitting in stock. It was invested. They sold it to cash it out.
It was sitting in in the Fidelity S&P 500 fund.
Yeah.
And
that's a good way of thinking about it. Put it right back where it was.
And I actually planned to do it like this. I planned to so we built up our cash reserves. I was not planning on this to be part of our emergency fund. And so I had it in the S&P 500, and if I put it back in, it's just going back in the same spot. I mean, I'll put it into VTSAX, or I actually thought about putting it into the total international stock fund as well. But it'll go into one of those two.
Liz would love that if you put it into the international one.
Shout out to Liz. She'd be proud of me on that decision. Yeah. So then I'm just putting it right back in the same spot.
Well, I feel like you need to report back because by the time this episode airs, I think you will have made a decision. Yeah. So we'll post on Instagram what you decided to do.
Yeah. I'll give a listener update. So those are the trials and tribulations of Andrew's financial decisions last week.
Yes. So we've handled our first listener Q&A, and I'm not sure what the answer was, but you've got some options to weigh. Yeah. The answer is do what makes you feel good. Do what makes you, feel good sleeping.
Crystal and I also had a conversation about this on Friday because I said to her, I was like, there's no way I'm making this decision by myself. I was
going to say, does she have a strong opinion on it, or is she like...
No,
Do what
No.
Okay.
She will, as the CFO, she will trust the decisions I'm making. But on this one, I'm going to make sure that.
Did she push you in one, like, is she feeling one way or the other about it though? Like, I know she's like, oh, you decide, but.
No, her only point of view was that we should take some of that money and actually put some new windows in the house.
Oh, that's a good one.
So
yeah,
we need new windows. So that will probably be it.
Okay. It's exciting. It's about as exciting as a new roof. Actually, I think windows are more exciting than a new roof. You at least get to see them and enjoy them.
Given how cold it was here in Atlanta and how the wind was blowing, it was like you could feel the wind blowing through our house.
Wow. Yeah. Okay. Next question. We had a lot of questions about this. And so I just want to speak to it at a high level. We get questions around how specifically to calculate your net worth and what to include and not include. And I think people are asking, and more specifically, what to include and not include when you're doing the 25 times math, right? Which is that is the 4% rule. And we've done, whole episodes. You can actually go back and listen to episode 22, which is how much do you need to retire, flaws in the 4% rule. But we also explain the 4% rule in that episode, and which is another way of saying you need 25 times your annual expenses in order to be able to, quote, retire. We just get a lot of questions from people on, if I do the math and it costs me $100,000 to live a year, and I say, okay, well, that times 25 is 2.5 million. So I'm trying to acquire a 2.5 million net worth. People want to know, do I include my house value in that? Because like me, for example, my house is fully paid off. So a decent sized chunk of my net worth is in my home. Do people include their car values, et cetera? And what do you think? There's no right or wrong answer here.
Yeah. So when you're talking about your total net worth, yes, all assets should be included and all liabilities should be subtracted. So when I'm calculating my net worth, I include the house, the cars, all the accounts, and then
I include my kids' college funds, even though I'm not planning on spending that for retirement.
And then on the liabilities, I include the credit cards are the only debt we have that are paid off each month, but they get included when I calculate it. As far as that's one in terms of like when you're talking about your net worth, yes, everything's included. When talking about what do you need to live off of in retirement, I'm a bigger fan in general of using what I call liquid net worth, which is things that are excluded from assets that are there to generate income. So if you're trying to replace an income in retirement, I only count assets that are actually generating income.
Yeah. So if you plan to sell your house when you retire and buy a house that's worth half as much, then you would include, half the value of your house in that more liquid net worth as an example.
Yeah. And the house is the big one. And I think everyone's situation is a little bit different, but in broad strokes, if you have plans to stay in this house until you die and or pass it down to your kids, right? There's no plans to sell the house, then yeah, you shouldn't be including it. But if you have a house and you are definitely going to be downsizing it and you want to move to an apartment or you're going to move to a lower cost of living, then yes, you include the house sale, those proceeds, and you want to on a net basis, right? What's the net
after
realtor fees, after taxes if you got capital gains, right? And then that can get approximately how much more, and this is where a tool like Projection Lab is really good because you can model that in and you can factor in, okay, well, these are the proceeds that I'm going to get. This is then going to go into a brokerage account and start generating income for me and growth.
Yeah, you could put the year you plan on selling it, and
right?
You could forecast all that,
and then you got to put in a rent forecast as well. I'd say in general, I typically will exclude the house from those forecasts.
Yeah, I agree. I think house and cars, I would say, because some people's cars might be worth a lot. And,
right.
I think the reminder there for people, just to recap it, is you should think of your total net worth as different than your 25 times retirement number. Right. And Andrew said it as in that 25 times retirement amount is more your liquid net worth. So I'd want to remove, my kids' 529 accounts, my house, anything that again, isn't something that I'm going to spend in retirement. Okay. Related question, Andrew. I get this a lot from people, and I think you do too, is how do you account for and include something like a pension when doing your retirement calculation and in the 25 times rule?
Yeah, this is a great one. And pensions are something of the past, but they definitely are still out there. I was working with a client last month, and he's a veteran, and so he has a pension, a government pension. And I have not seen many of these too often, but it's pretty straightforward. They're not taxed, and they are, well, in this case, this one wasn't. And so, for round number purposes, if you have a $2,000 a month pension, and that's $24,000 a year annually, the way I think about it is how large of an asset would I need in order to replace or to generate $24,000 a year of income? And so on the math side, you just take the annual pension and you divide it by 4%. And so on $24,000 divided by 4%, that's $600,000. So essentially, this person needs $600,000 less of liquid assets to generate that $24,000 of income, and so it's a big number, especially if you get up into like a $3,000 or $4,000 a month monthly pension, which is not unheard of. And you could potentially need less than $1 million or $750,000 less of income. And a lot of pensions are tied to inflation as well. So it's a inflation protected pension, which is very beneficial for protecting you against inflation risk. So yeah, it's great if you've got one.
Yeah. The other way you can think about it also is, actually like Andrew's way better for what it's worth, but just so you get your mind around the spirit of a pension, because Greg has a small pension that he gets from like some period of time when Piedmont had a pension plan. And, it's like $900. So there's a set of years where he will receive $900. It's not inflation adjusted. And so we can, $900 times 12 months, we can do the math on how much that will reduce our annual expenses during some portion of years, and then have a better sense of what our 25 times number looks like. But the reason I like Andrew's method is because it's just a little more simple, because, right, he's going to only get that pension for a certain number of years. And so it reduces some years' expenses, but not all years. And so it's harder to think about it and wrap your head around it. I like the idea of just having a number. And a lot of companies, like Greg had an option at one point to buy out his pension, like they cash out your pension. They were changing the plan. And so you could either keep it or you could get it all cashed out, and he kind of ran the math on the two. But they're essentially, that is a similar way of thinking about how you've turned it into a number of, what it's worth today in terms of your net worth.
And you can use your own, I just used the 4% rule, but if you were targeting a 3.5% withdrawal rate, then you just divide by 3.5%.
Be as conservative or as aggressive as you feel like you want to be. I always like to be more conservative, and I like to sort of plan for the worst, hope for the best, plan for the worst.
Yeah. So Maggie, that $900 a month pension that Greg's got's worth $270,000.
Okay. I like it.
Yep. Crystal's got the same one.
And it's not going to grow. I'm going to leave it as that number in terms of how I keep it in my net worth. I'm just going to leave it sitting there as 270.
Yeah. Yep.
I just want to clarify that. What were you saying about Crystal?
She's got the same thing from being a teacher for 10 years. It's a small, right around like, I think $800 or $900 that starts at 65 or something. Yeah.
Okay. This is a good question. And I got this question recently from a listener. And when I received it, I was like, oh, we could do an entire episode on this question. But I think it'll be fun to do like a mini episode and like have to we can each give our pithy answers on it. And you should go first, Andrew, because you're pithier and just everything. So here's the question. Do you have a plan that you will execute when the next market down cycle comes around? For example, Roth conversions, adjust spending, equity-based line of credit. And this person was asking it from a early retirement standpoint. They from someone that does not have a income coming in currently.
I'm going to panic sell everything and move to cash.
He's just kidding. Just want to clarify that. We should have given a big disclaimer on this episode, by the way. We are not financial planners. We don't know your personal specifics. This is just for entertainment purposes
Entertainment purposes only.
Don't sell everything. Correct. Like Andrew just said, or do if you want to, whatever you want.
So this is from a perspective of you're in retirement already, right? In that case, I would first take a look at my withdrawal rates and my expenses. And depending on the size of the market drop, I would potentially recalibrate some things. I think everyone has their what they consider their essential expenses. And then hopefully you've got some room in your budget where you have some nice to haves as well. And you're not completely on the lean fire path of, hey, we're kind of already at the bare bones. But I would take a look at those nice to have expenses and potentially maybe do some trimming on that. And coming back to Projection Lab has a awesome new feature where they have a flexible spending plan where you can actually tie your flexible spending expenses correlated to the market drop. So for example, it will model if the market drops 20%, I'm going to cut my flexible spending expenses down 10%. And then that gets input into the Monte Carlo simulations. And so I've now, with all my clients, I'm now doing that because it's a great way, because that's what human behavior is going to be, right? And that's why it's my biggest criticism of the 4% rule is that it doesn't take into account human behavior. Mm-hmm. If you had a $2.5 million liquid portfolio and the 4% rule says take 4% on the year that you retire, and then you're going to adjust that for inflation going forward. And so you're generating $100,000 in year 1, 2, 3. Suppose in year 4, the market takes a massive dump and drops 50%, and now your portfolio is $1.25 million. Are you really going to continue to take out $100,000 in that year where your portfolio just dropped 50%? I don't know a single retiree who would actually do that. And some retirees may have less wiggle room to do that, where, they may not want to cut their $100,000 a year lifestyle, but every person I know would make some changes to their lifestyle. And so I think that's a key part of this.
Yeah. I would do many of the same things, but just to add some additional thoughts to that, I think there are so many nuanced factors to each individual person's situation and reality. And quite honestly, like the phase of life you're in, it's hard to answer that question on what I would do today versus what I would do 5 years from now or what I'd do 2 years from now. And so for me, I would decide on the fly in the moment based on what phase of life I'm in. And I'll give you an example. I would definitely cut my expenses, right? There's a lot of like nice to have things in my budget. Probably half of it these days that I could easily cut back and would not be, miserable. I also like to remind people that $100,000 example where you're like $100,000 in expenses, you're not taking it out all at once, right? So if the market drops suddenly, I'm taking out like literally what I need that week or that month, right? I'm taking it out in very small increments. And I can adjust things. So if it goes down and then it goes back up, and then I might feel more comfortable taking a little bit more out. And so I would adjust it. And I also might do some things to produce income, right? If in addition to cutting expenses, if I was nervous. So especially back to the phase of life, like if my kids, I am 2 years, this is scary, 2 years away from all my kids driving. Right. And so, and I just
You're
say
like
that
2 years from a free woman.
Well, I just say that because like the amount of time we see our child who has a car versus the other two is dramatically different, right? They're so much more off on their own and like and they're just older and they have busy lives. Oh, Maddie is just always gone. We always joke. We're like, you're never here. And then when she is here, she pops up and she like wants something immediately. And I'm like, I didn't even know you were going to be here. Like, I'm happy to make you some food. Yeah, I'm just like, I'm happy to make you some food, but like, I don't know when you're going to be here. I haven't seen you in days. And so I say that as in, I don't want to work now Right. I've done some even small experiments in some kind of small side hustles is the wrong word, but income producing things. And I don't like it right now. Like I really value freedom and availability to be there for my kids and be able to, spend my whole weekend in a volleyball gym and then be able to, catch up on other things during the week. And so, but when my kids go off to college, when they're just around less, like I might enjoy a part-time job, right? And or doing more financial coaching or doing, something. I don't know what, but my point is you could go back. I always know I could go back and make more money if I had to, right? If there was some sort of massive, decline in the market and I've really felt uncomfortable spending at the level I wanted to help my kids through college or whatever it might be. And so I like to remind people like, the levers you can pull. And this person gave examples of, Roth conversions and adjusting their spending. I probably would not take out an equity-based line of credit personally, but there's a lot of levers you can pull in terms of levers that will save you money and levers that will make you money. And they can dramatically change the math. I mean, from just stuff you can put into Projection Lab, Andrew, sometimes just a $10,000 increase in a little bit of extra money throughout a year even dramatically changes the forecasting, right? And so, or cutting $10,000 on the flip side. And so I think it's just remember that you have control over a lot of levers and you can decide in the moment when you need to, what levers you make sense to pull at that time. And, it's like a lot of things, like it's good to think about it and it's good to play through those scenarios in your head, but you don't need to make an actual decision on something that hasn't happened yet. And you don't need to stress about it either, in my opinion. You just need to educate yourself and be aware of the levers that you could pull.
Yeah. And I'd say the biggest thing when it comes to equities and the assets is resist the temptation to sell, right?
Oh, yeah.
And obviously it sounds like the most obvious, but it's the hardest. And all the data shows that the retail investor buys high and sells low. And so if you can avoid that, it's much easier to say than it is actually to do. And
they call it panic selling, right? Like don't panic sell. Right. That panic selling is different than saying my plan in early retirement is to slowly sell off my investments as I need the money to live. And so, the market's down. I'm going to sell a little bit for the amount I need $5,000 this month. I'm going to sell $5,000 worth of stock. That's okay. That's not panic selling.
Right.
Panic selling is selling everything because you're like, oh my God, I want to cut my losses. And you just remember like, this is a long-term game. Like I'm in it for the long term. You probably shouldn't be investing in the stock market if you're not in it for the long term.
Yeah.
Okay, next question. I was laid off from my corporate job in April, and that 401k is with Fidelity, but I understand they're going to start charging fees as I no longer am an employee. I just started with a tiny tech startup, and they use a third-party company to take out pre-tax dollars, and you can select where to invest. I don't really want to transfer my corporate 401k to this one because I have no idea how long I'll be in this job. So do I just keep the old one in Fidelity? Are the fees that much of a concern? Thank you. By the way, very sorry that you lost your job. I'm glad you've got something kind of temporary to fill the gap, it sounds like. I think this is a super easy one. You could just, that Fidelity one that's with your company that will charge you fees when you're no longer an employee, you could just roll it over into a rollover IRA with Fidelity and a personal Fidelity account. You open a Fidelity account, open a rollover IRA, and then they have a whole online transfer process. It's actually a lot easier because they're both with Fidelity, and you'll roll it over and there'll be no fees once you're with Fidelity as a personal customer.
Yeah. The one caveat is if you are a big fan or are anticipating on doing the backdoor Roth, this then makes you subject to the pro rata rule. And so the fees may be worth it if you want to continue to do a backdoor Roth.
Do we have an episode where we explain the pro rata rule, Andrew? Do you want to explain it briefly?
It's super complicated. And in most situations, the pro rata rule, it makes it so the backdoor Roth is not nearly advantageous as it was. My own personal example is it was not worth it for me. And so I think that
it was not worth it for you to roll over yours?
No, it was not worth it for me to do the backdoor Roth because of the pro rata. I had enough of an amount in the traditional IRA because I had been diligent in rolling over all of my former employers over the years. And so, and unfortunately, Carter's didn't allow outside contributions to roll it back in. So I would probably, if you're not going to do the backdoor Roth, then yeah, rolling it over into traditional is fine. If you are planning to do it, I would probably keep it where it is and then potentially wait until you get to another company that allows you to roll it over to them. And so then you can avoid having to deal with the pro rata rule.
Yeah. And I'll give you like a brief description of the pro rata rule that I am reading directly from Google, just to clarify. But this is one where like you should consult a professional or, dig into it on your own and go learn about it.
It's a very complicated subject.
But at a very high level, the pro rata rule dictates that withdrawals or conversions from traditional IRAs containing both pre-tax and after-tax, aka non-deductible, money must be taken proportionally. So the IRS regulation ensures taxes are paid on a pro rata basis, preventing users from withdrawing only tax-free after-tax funds. It's critical if you're performing backdoor Roth conversions, like Andrew mentioned. So again, this could probably be a whole separate episode. Actually, those are the ones that to me lend themselves like not great for a
agree.
Podcast.
They're almost too complicated.
Yeah,
it's almost like you need charts and slides. They're good for a YouTube channel.
Yeah, right. But I think the point for the person that was asking this, aside from understanding the pro rata rule, is just that your new company's 401k has nothing to do with your old one, right? You can roll over that old one whenever you want, obviously considering things like the pro rata rule. Okay.
And maybe it'd be helpful if Congress just made a new law so we didn't have to go through all these crazy shenanigans to even that the backdoor even exists, right?
Put that in the suggestion box. Okay, we're going to cover like our last ones. We're going to do some quick questions, quick hits, okay?
Okay.
Any tricks for lowering cable and internet?
Cancel them. And then the companies will offer you a better deal.
That's a good one. That's what I was going to say. Pretend to cancel it,
Yeah.
But yeah, you go through the process of canceling. They'll normally send you to a retention department, a different department. But I will say sometimes you just can't get a lower price, right? Not always, but it's hard in Atlanta. There's only like a couple providers in our area.
Especially mobile phones have changed completely the landscape where it's so much more competitive now. People like Mint and Visible and all these low cost providers came into the market. And it's always a great example of how competition makes the market more efficient, because I remember the days of $90 and $100 cell phone bills were super common per line. And now it's in the $15 to $25 range.
Yeah. What are you paying for internet a month right now?
$67 a month.
6-7? Yeah. Andrew. 6-7. Okay.
Brendan would be so happy.
I know. That is a very specific amount, by the way. Yeah. We are paying like 70 or 75 now. I think we were on a promotional thing. It went away. And that's when I'm like, it's actually time for me to call, pretend to leave again. And I'm maybe best case going to get $5 off my bill a month based on my past experience.
Yeah, and I've tried this a bunch of times with Comcast as well, that I'm pretty much at the lowest that they will offer. They've been willing to let me walk at lower than what I'm at. Right.
I'm with AT&T and same thing, and we're on the lowest. Like we're not even on the highest quality internet we can get. Also,
I have debated going to T-Mobile or some of the over-the-air providers.
Yeah. I've looked into those recently
as potentially just to try and get Comcast to come down, right?
Yeah.
But it hasn't been worth juice hasn't been worth the squeeze.
That is one of the best things you can do, is aside, like Andrew was kind of half joking when he said quit them. But if you have an actual competitive offer, like a real competitive offer that is in your market that you could move to, calling and having that versus just saying, I want a lower price, but actually calling and saying, I have this offer. It is for Verizon 5G home internet and it's X dollars a month and it's the same speed and the same quality, whatever it might be. I'm also hoping Google Fiber comes. It's like, I'm on their mailing list for years. Doesn't seem to be making its way to our area. Okay. Another quick one. This could be a long one, but we're going to give our pithy quick answers. First year starting to make 200,000 gross. Anything we should do / no? First off, congratulations.
Yeah. Great milestone. I would be making sure that everything is maxed. So 401k for both, if you've got two people working, maxing the 401ks, you're above the Roth threshold at this point. I think it depends if you're single or married, filing jointly. You may be able to do a partial Roth. And then second, at this level, making sure you've got a brokerage account and you're dollar cost averaging into a brokerage account.
Yeah. Just to clarify on the maxing out, like 401k, or if your company has 457B or like other versions of that, I always like to clarify, we're not talking about maxing the company's match. Some people get confused by that. We're talking about maxing out the IRS's legal allowed amount that you can contribute, which reduces your taxable income. And in 2026, that amount is $24,500. Or if you're over 50, it's $32,500. But let's say you're under 50. That means between you and your spouse, you can put in almost, I can do this, it's easy math, $49,000. We'll just say almost $50,000. So, I mean, you can reduce your taxable income right away by 25% just by putting that money away. And if you can participate in an HSA, max out the HSA, those are magical things you can do to reduce your taxable income and save for the future, which is amazing. And I would make sure you save some extra money for taxes, because if that's a new increase, your withholdings may be a little off if it's two different companies. I don't know if that's two partners working or if that's one person's. But some people, as they start to make more income, get surprised by larger tax bills. And so just make sure you've got money set aside and planned for that. You can always go to the IRS website and do some estimates throughout the year also. Okay. I got a one where I'm just going to direct people to an episode. So we'll cover this: how to plan the amount of cost increases as kids age. I have been fairly vocal that I think as kids age, expenses get higher. We've at least noticed that in our life.
There's a curve. So it starts high through the daycare years, and then you get a nice little bump or a decrease when you hit kindergarten through, I'd say, probably third, fourth grade. And then I think when fifth, like middle school, right? The elementary school years you get a little bit of a break, and then middle school, and I've yet to see high school and certainly college. One of the biggest things when I was talking about leaving work, my mom's first response was, Andrew, do you know how expensive college kids are? Not just how expensive college is, but how expensive college kids are. Yeah. She likes to say that me and my two sisters blew through a lot of money in our college years.
Yeah. I mean, I know how expensive high school kids are, and I can imagine when they're not like under my house to watch all the time, they're just going to get more, going to get more expensive. And I'll point you to two episodes where we do talk about like kind of the rising cost of kids. They're actually both listener Q&A episodes, but I'll put a link in the show notes to those if you want to hear more thoughts. I think Greg and I share some thoughts about how our expenses have increased since having kids, but I think it's more to plan for it, right? So the person's question was how to plan the amount. I don't think there's like an exact amount, but you can, assume a 10 to 20% increase in certain things. You can put in some placeholders for kids' sports, and a lot of it just depends on your personal situation. But I would say plan an amount, regardless of what it is, and just do your best to estimate them eating more food, playing more sports, and wanting more things, and cell phones and car insurance, and like all these things are expensive. Okay. Speaking of expensive, I thought this question was kind of funny and like super timely, because this question came in like 12 hours after an episode dropped where you referenced this. And I think in our second expense review episode, part 2, we were sharing homeowners insurance costs, like what we were paying. And you said something about the size of your house. And so the question is, why did Andrew and his wife buy a big house with 7 bathrooms?
Good question. First clarification was I miscounted, and we have 6 bathrooms.
Because you don't even know how many bathrooms you have. 6 or 7. We're not sure.
So this is we lived in a different house when we first moved to Atlanta for about 15 years. And when my daughter was going into kindergarten, we moved into this house. And when we were searching for a new house, we were looking for a very specific school system. We actually limited our house search to just a single middle school that we wanted. And the reason for that was because it was in the southern part of where we wanted, and it would make my commute to Carter's be more reasonable. And this was pre-COVID. I was in the office 5 days a week, and also proximity to the airport was also important because I was traveling so much. And so we had a very small little area that we were searching for. And the size of the houses, or the type of house that is available in that area, is fairly uniform. It's not like there's a lot of variety within.
You're not going to find like a 3-bedroom, 2-bathroom.
It's going to be, and so that kind of, and it's a much older house. It was built in the early 80s, as many of these houses were. And so that's what really drove that. Would we have preferred to have a smaller house? Yes. And it wasn't necessarily, we were absolutely looking for, we had to have a larger house, but
well, it was a lifestyle neighborhood decision.
It was
a neighborhood you wanted to be in, and
correct.
That's what versus in my neighborhood, which I also wanted to be in. There's a very large, it's a lot of like older homes, and so many of them have been torn down, and there's like what we call McMansions built up. Andrew's neighborhood, they all got torn down at the same time. I'm not even at the same time. I'm half joking, but it's all been rebuilt.
Well, this was all like this was all completely undeveloped land, and so our neighborhood was built in the early 80s, and
on top of a dump, as we know.
Correct, right.
If you know what we're talking about, you'll know it's not worth getting into. Okay, I like that we have clarified you only have 6 bathrooms, though. Okay, this is another question. We're going to wrap up with this question, Andrew. Okay. Are you ready?
I'm a little nervous about this one.
You shouldn't be. There's nothing to be afraid of here. Okay. This came in from Instagram. Oh, I didn't even realize who it came in from. It came from Kathleen, who has a podcast of her own called the Reframe Podcast. I really like it. She used to be Minimalist Mom. I'm going to finally get to meet her in person at the Campfire Rocky Mountain this year.
Great. Kathleen and I are Instagram friends.
Oh, nice. Yeah. Okay, so this is her question. You can give her credit for it. Pick one. And before I say them, she clarifies after this. You can only have one. Which do you choose? Biking or frugality? You get to keep your family. You don't have to choose them, you know?
There's a long pause here.
Mm-hmm. I feel like the question should be clarified as competitive cycling. Like, it's not like you could never get on a bike again.
Well, okay, that was what yeah, sure. I'm going to give up competitive cycling because I think there will be a time when I do give up competitive cycling. I don't think I'm going to be, well, I know I'm not going to be racing at this level forever.
Okay.
So,
but what if you could never get on a bicycle again?
Well, I'm picking the bicycle.
Okay. So you would pay a tax. Let's say there was a bicycle tax.
Yeah. I do not advocate for having to register bicyles. The law that is just passed in New Jersey is
seriously?
Absurd. Yes.
That's a thing?
Yes, it is.
That's weird.
But I'd be paying a tax to ride the bike.
Okay. I like it. Good question. Good news is you don't have to choose.
Correct.
You can keep both. Congratulations.
Kathleen went right for some of my 2 most passionate things in my life, right?
But that's why I said she didn't make you choose your family. She's not an unreasonable person, you know.
Also, shout out to Kathleen. Congratulations on firing. She left her job at the
she early retired.
Retired at the end of last year. So
she was like a partner, and I don't know if she was a partner, but she's like a big job at a law firm.
We should have her on sometime.
She's been on.
She has?
She came on. Yeah, she came on, and well, not with you, but she came on with me, and we did an episode on Stoicism.
Did I not?
Yeah, you not heard. Listen to it. Hold on.
Right.
Let me tell you which one.
I'll have to go check that out then.
It is episode number 115. And she came on as a guest co-host, and it was Mind Over Money, How Stoicism Can Transform Your Finances with Kathleen from Minimalist Mom.
Maybe I just thought that you were on hers or something. Okay.
I think I've been on hers also. It gets confusing. This is a very,
tight-knit community.
Tight-knit, financial frugality podcasting community. So we've all been on each other's podcasts. Okay, that's it. That was we that's not really it. There's always more questions, and I'm sure we'll do another Q&A question one of these days, but I hope that's been helpful. I kind of like tackling these like small mini ones sometimes. Yeah, these are good. And it's always good to hear from listeners. Maggie, you sent a listener my way last week, and
it's a good reminder that there are actually people listening on the other side of the microphones.
Yeah.
Right?
Andrew, I sent a listener's way because Andrew does, you mentioned it briefly, but does do some financial coaching. And I know you put a lot of your clients in Projection Lab, I believe. And anyways, if you ever need someone, reach out.
Yeah.
I send many people his way.
I enjoy it. I love talking about this stuff.
Okay. Well, thank you guys for listening. We always appreciate you spending some time with us. If you've enjoyed this episode, or maybe we answered your question today and you want to give us a written review on Apple Podcasts, we really appreciate it. You can also leave a rating on Spotify.
We also encourage you to share this episode with a friend or family member to encourage ongoing discussions about money. You can also subscribe wherever you listen to podcasts. If you have thoughts or questions, we'd love to hear from you. And you can leave a voicemail or text us at 404-981-3370 or hit us up on Instagram.
Awesome. Thanks, Andrew.
Thanks, Maggie.
Bye.
Bye.